Hey everyone, in today's video, we're going to talk about a big change that's quickly gaining momentum in the financial planning and wealth management industry. This has the potential to save you thousands of dollars in fees. And I'm going to walk through an example of this, and I think you're going to be shocked at the difference. You know, the way consumers have paid for financial advice has changed a few times within the past few decades. For many years, the only way to get access through the market was through a broker who would place trades for you in exchange for a commission. And as access to the stock market became easier through the internet, the financial services industry had to pivot. They started charging clients an advisory fee based on their assets under management. And today, this is how more than 90% of firms charge, according to a recent study by Investment News. But as individuals have gotten access to more information and arguably gotten smarter, they've started to ask a few questions about this advisory fee arrangement that's based on a percentage of their accounts. So they're asking questions like, does my $3 million portfolio really require 3 times as much work as someone with a $1 million portfolio? Let me tell you, after doing this for more than 20 years, I tell you that answer is absolutely not. Another question is, why does my advisor discourage me from spending my money? Well, it's fairly easy to follow the money here. Let me give you a quick story about a case that I had last week. Someone that we were working with had found their dream house, and it was $1 million, so it was not a cheap house. But this client had a lot of money, and the house was right where he wanted to live and right in the middle of where his kids and grandkids had all settled. Now, when he asked his financial advisor about helping him figure out the best way to pay for the house, should he pay cash for it or should he finance it, he was strongly encouraged to get a loan. And have you seen interest rates lately? So the client started to wonder, now, wait a minute, is that the right move for me? Or is that the right move for the advisor? Because since he was paying a 1% fee, a decision to reduce that account balance by $1 million to buy the house would result in a $10,000 annual revenue loss for the advisor. Now, I don't want to believe that biased advice like this is all that common, but the simple truth is that a revenue loss of that size can at least subconsciously influence someone's recommendations, and this does present a conflict of interest. And another question that we hear quite often is, why do I have to pay my financial advisor more than my CPA and attorney combined? A 1% fee sounds pretty small. It's innocent. It's just 1%. But when you quantify that in terms of dollars, it can grow to a staggering amount. It's fairly routine that we see people who are paying $20,000 to $30,000 a year and even more in advisory fees. So I think all of those questions that consumers have started to ask are fair questions. And this is why we're starting to see the flat fee financial advisor model building momentum so quickly. This is where you pay a flat fee in terms of dollars, whether you have $1 million or $10 million. For those with larger account balances, I think a flat fee advisor could be an excellent choice for several reasons. But today, I just want to focus on one reason. That's the fee difference. Let me give you an example of just how big this difference is. Let's take someone with a portfolio value of $2 million. They want to take a 4% annual distribution for living expenses, and they want to increase this by 2% each year to keep pace with inflation. Now, over a typical 25-year retirement period, a seemingly small and innocent 1% advisory fee would add up to $650,000, almost $651,000. Now, when we compare that with a flat fee advisor who, let's say, is charging $10,000 annually and adjusting that fee by 3% each year for inflation, then over that same period, this would amount to $364,000 and some change. Now, at first glance, that's a direct savings in fees of more than $286,000. But that simplified calculation doesn't account for something critical. That's the time value of money. When you consider the impact of those extra fees just remaining in the investment portfolio and compounding at, let's say, an average rate of 7%, the difference becomes even more staggering. And the best way to measure this is by the account values after it's been adjusted by the income distributions and the fees that have come out. At the end of the first year, there's a difference of just over $10,000. By the end of the 5th year, this is more than $60,000. By the end of the 10th year, this is about $150,000. By the end of the 20th year, it's more than $450,000. And at the end of that 25-year period, the difference is $707,000. So, needless to say, if you have a larger portfolio, this is something that you need to start researching, because it can literally mean the difference in hundreds of thousands of dollars that you and your family gets to keep instead of giving it to your advisor. And I know you like your advisor, but do you like him that much? Now, having said all of that, a flat fee advisor isn't for everyone. If you have a smaller portfolio, say under $1 million, the traditional asset under management model might be more cost effective. And then also, if you're comfortable managing your own investments and you don't think you're going to need the ongoing comprehensive advice of a financial advisor, you can generally find a financial planner to work with you on an hourly basis and just hire them occasionally to answer questions. But if you're looking for a flat fee financial advisor, they are becoming easier to find. My firm, for example, caters to clients that have between $1 and $12 million in investable assets. And if you want to see a list of other flat fee financial advisors, you can visit my friend Andy Panko's website. He has a list of 32 other firms who are also flat fee that you might otherwise never hear about. But one thing is for sure, this is your retirement, and no one is going to feel the pain of mistakes like a research like you will. So keep taking the time to get informed, and don't be scared making a change that could have a massive result. Well, that's it for today, but if you found this information valuable, please remember to like this video and share it with a friend too. And don't forget to subscribe if you haven't already, because I've got more like this coming. Thanks for watching.